This should not have happened. One of the largest hedge funds in Wall Street crashed and almost took down with it the entire stock market. What's happening right now is very similar to what has been happening back in 2008 when the entire global economy has crashed. Leonard Aschenbrenner, who is a 24-year-old former researcher at OpenAI, left OpenAI and started a hedge fund by investing in AI companies because, according to him, artificial general intelligence will be available by 2027. So if we make the right investments, we will end up making a lot of money. But what happened is that his $45 billion hedge fund completely crashed, and investors almost not just lost the entire money, but the entire Wall Street almost went down. And it basically showed us how the AI bubble crash is going to look like. His prediction was that if artificial general intelligence will be available by 2027, we need a lot of computer power. And that means we need a lot of hardware. Hardware means high bandwidth memory, computer chips, a lot of data centers. And at the same time, it means that artificial general intelligence is going to automate a lot of software. So software companies will become obsolete because you can ask the artificial general intelligence to build you whatever software you want. So companies such as Adobe will become obsolete, so we can actually short them and make a lot of money. He went on and founded Situational Awareness in 2024, and his rich friends back in Silicon Valley gave him billions of dollars to invest in these companies. Because if that's going to happen and you make the right investments right now, you will end up making a lot of money. He invested a lot of money in hardware, companies such as SK Hynix, CoreWeave, and Micron. SK Hynix is a South Korean company that produces high bandwidth memory. And these are the kind of wires or the cables that you need in order to build these data centers in the first place. Without them, you're not going to connect these high computer chips to make AI possible. The same thing goes with CoreWeave. This is the company that buys computer chips from NVIDIA and builds these large data centers and rents that computer power to these companies to train their AI models. At the same time, he shorted companies such as Adobe. And they seem like a wildly great success story because his hedge fund recorded almost 1,000% in less than 2 years, and the peak valuation was $45 billion. Imagine this guy in less than 2 years makes almost 1,000%, while the average return on the S&P 500 is about 10% annually. I think his investors were insanely happy with the kind of performance that he showed him. But the market overnight literally flips and he almost loses everything. Micron, one of the companies that he invested in, loses 25% of his investments. And suddenly he starts getting margin calls. And at the same time, Adobe rises and it rallies. Because he shorted the stock, suddenly he's also losing on this position as well. His brokers starts sending him margin calls. His brokers are Bank of America, JP Morgan, these large banks that allow you to trade with margins. And when you're getting margin calls, suddenly you have to sell your investments to pay back your brokers. So he was forced to sell $20 billion of his assets below market price to Citadel. If you want to get rid of these positions to pay back your brokers, you got to sell these positions. So Citadel, which is another hedge fund in Wall Street, was sitting down there and purchased these stocks below market price. So I guess now Citadel's investors are insanely happy because they got this amazing deal. They got these really great stocks below market price. And the valuation of the fund went below $10 billion from $45 billion. Even though that he lost so much money, if you look at the calendar year, the hedge fund is still up by 87%, at least according to him. So massive crash should have started because of this, because we have one of the largest hedge funds in Wall Street receiving margin calls, but it didn't. The entire market didn't actually took down with them the rest of the market. Why? You see, after the 2008 financial crisis, banks were required to have a lot of restrictions. And those restrictions do not allow banks to take these huge risks. And that's why when one hedge fund went bankrupt in Wall Street, it did not take down with it the rest of the economy. In fact, if you look at the banks today, They have to go through a lot of stress tests to ensure that they can actually survive this type of crises. And also they have to maintain a certain level of liquidity to ensure that if something like that is going to happen, they have enough liquidity to survive such a crisis. At the same time, these banks are no longer allowed to have so much toxic assets on their balance sheets. Back in 2007, all these mortgage-backed securities that were borrowed by the average people and they could not possibly pay back the mortgages on these houses, all those mortgage-backed securities were sitting on the balance sheets of these banks. So the moment there was a massive sell-off of these mortgage-backed securities, those MBS on their balance sheet of the banks became very toxic and they started selling them. Even if they did not sell them on paper, their valuation was so much down that we had a banking crisis. That banking crisis was the reason that the 2008 financial crisis was so insanely bad. So banks got their money back with the situational awareness. So this hedge fund goes down. It starts selling its own assets to pay back the banks because this is not banks' problem. And these bad investments were not on the balance sheet of the banks. So does that mean that we are safe from another major crash? Does that mean that AI crash is not actually going to happen? Well, let's give it a very closer look because the situation with this hedge fund is much more complicated and there are a lot of nuances that people are not paying attention. Now ask yourself, how do you make 1,000% in less than 2 years? There is only one way to do that. You're going to use a lot of leverage. That means that for every dollar you're going to put and buy stocks, you're going to borrow more money. And the leverage ratios that this hedge fund has used is 4-to-1, which is 400%. So for every dollar of stocks that the company has purchased, it borrowed another $4. And that means that, yes, when the stock market is growing by 100%, you are making 200%. When the market grows by 200%, you are making like what? 400% or more. But the opposite happens when the market goes down. If it goes down by 10%, you're losing 40%. But if it goes down by 25%, you're literally losing 100%. So situational awareness mathematically was already bankrupt the moment the stock market or the stocks that this company used to hold went down by 25%. You're literally broke. You're supposed to sell absolutely everything just to be able to close your positions. Even though that he was right about AI, there was a lot of demand for computer power. We have all of these companies spending hundreds of billions of dollars to build the data centers all across America. They are spending so much money buying computer chips from NVIDIA. His hedge fund still got crushed because the moment any kind of an investment in the market turns into a huge bubble and there is no real prospect in the short run that it's visible how this company is going to earn its money back, investors instantly sell off and you will end up losing your entire position. That's why you might be right about the technology, but it doesn't mean that you're actually going to be right about your investments. But here's the biggest problem with this hedge fund. Back in 2008, the reason that the market has crashed was because the banks started going down one by one because they had all of these toxic assets on their balance sheet. What is happening right now is that banks are safe, but a lot of hedge funds today are sitting, or most hedge funds today are managing about $5.25 trillion worth of assets. And these assets are being used as leverage to buy far more assets. The leverage ratios between the hedge funds are anything between 2 to 4 to 6. Imagine for a moment what it means when you have a leverage ratio of 46. So for every dollar of asset you're putting to buy the stock, you're borrowing another $46. That means that even if the stock drops slightly, you will instantly be wiped out. Of course, 46 is the extreme, but even think about a leverage ratio of 1 to 10. That means that if the market or the stock goes down by 10%, you're out. You're losing your entire position. So the credit or the private credit defaults have crossed 6%. That means that private investors, their default rate has risen to 6%. So these are not public companies going bankrupt, but rather these are private investors going bankrupt. Now, at first, when you look at this, how is this even my problem? How can this probably crush the market? So imagine for a moment that a private company defaults. Now, they declare bankruptcy. This number has risen to 6%. Ideally, this number never goes above 2%. Then they're forced to sell their good assets to get out of their positions. If you're a private company, and let's assume that 50% of your money is being invested in very safe, good investments, such as the US Treasuries or the large big tech companies like the Magnificent Seven, and the other 50% that you have actually used to leverage your positions and buy these very risky investments where you want to make a lot of money. If suddenly you are faced with margin calls, you will have to sell your entire position just to close your position. That also means your very good assets, such as the US Treasuries, such as the safest investments that you have on your balance sheet. When that happens, suddenly the price of these even great assets also fall. Suddenly, you are dumping so much US Treasuries in the market. You are dumping the stocks of the Magnificent Seven in the market. You are dumping the stocks of very great, solid stocks in the market. And that means that their prices are going to go down, and that is going to take down very healthy companies. So even great companies in the market starts to suffer. And that is going to lead to a banking collapse as well, because banks are holding a lot of these assets. Banks are sitting on some of the largest US Treasuries in the market. By the way, that's exactly what happened back in 2008. When the mortgage-backed securities, the toxic ones, started going down, they brought the prices of these mortgage-backed securities so down that even mortgage-backed securities that were backed with very good mortgages, even their prices started going down. And that's why the crisis happened. So we're seeing something exactly the same is happening today, but not with banks directly, but rather through hedge funds. And if you look at the margin debts, you will be blown away. We have never actually had such huge margin levels at any point in the history. Right now, they have crossed $1.6 trillion. That means that all of these private hedge funds, private investors are sitting on so much leverage that even a small crash in the market can literally take them down. So how do you invest in this market when you don't know what exactly is happening and a massive crash could happen at any point? You might be buying this stock and suddenly the next morning you can see that stock going down, insanely down, just like it happened with this hedge fund. Well, if you think about it, there is literally just one way to ensure that you're actually making money in this market. And that's you find the true valuation of a stock, and then you simply buy the stock when it goes below that value, and then you sell the stock when it becomes overvalued. Well, how do you know that? Look at the price of Microsoft. Now, over the last 6 months, you can see that Microsoft fluctuated multiple times. It went as low as $350, for example, back in June 2025. It went to $356 back in April of that year. At the same time, it has actually risen to $470, and now it's being traded at around $464. If you would know the real value of the Microsoft stocks, you would buy it below that price and sell it above that price. So in the Investing Academy, I run a live stream and analyzed Microsoft live so everybody can see it. How do you analyze that company? And we found out that the true value of Microsoft back in February when this live stream was done was $390, which means that it makes sense to buy the stock below this price, and the moment it goes above $390, it's time to sell this stock. So we bought the stock at $370, $360. The moment it went to $450, $460, we sold the stock. When the price collapsed back to $350, we bought the stock again. And now the price has gone to $464. And guess what? We sold our stocks. And guess what's going to happen next? The price of Microsoft is going to go down again. So if you simply know how to find the true value of the stocks, yes, you're not going to make 1,000% of your investment, but you're certainly going to make a lot of money anyways. I literally take every single stock, analyze it, find its true value, and just wait for the right moment to buy. So if you want the full list of the stocks and at which price it makes sense to buy them, you will find them out at the Investing Academy. The link to the Investing Academy is in the description of this video.